Welcome to VRIC Media, the most trusted voice in metals and mining. And today I'm joined by Michael Oliver, the founder of Momentum Structural Analysis, and Shane Williams, the CEO of West Red Lake Gold. And today we're talking about gold, but most importantly, we're talking about how to make money in today's gold market, because physical is at and over all-time highs. A lot of the major miners are at 52-week highs. So if you're looking to capture upside in this gold market, serious upside, where do you look? And that's what we talk about today. We talk about what stage of the gold market we are at and where the major upside exists today. And good news, it's maybe the most opportune gold market that I've seen in my 15 years in this industry. Today, we're going to get into why and how to deploy capital accordingly. Here is Michael Oliver and Shane Williams on VRIC Media. Enjoy.
This is Jay Martin.
Okay, here I am with Michael Oliver and Shane Williams. I'm excited for this conversation. Thank you both for joining me today.
Great to be
on,
Jay.
It's going to be fun. So here's where I want to start. We have to start with some gold price conversations. World Gold Council recently put out their 2024 consumption numbers. It looked like around 4,900 tons in demand in 2024. And again, for the third year in a row, over 1,000 of that coming from central banks. And some interesting developments on the macro front. Like, I don't know if you saw China's running a pilot program to now allow their insurance companies to invest in gold. And we're seeing all kinds of little macro activity that we weren't seeing 4 or 5 years ago. So, Michael, I'll kick it over to you to begin. You seem, when I watch you, you seem pretty good at removing your emotion from the gold price and getting down to sort of pragmatic analysis. So how do you interpret these headlines?
No, I think the headlines we see that come and go, and they cause this thought process and this sense of doubt or this sense of confidence. There's a bigger picture here. And, I've been in markets since the 1975 when gold was legalized. I was in my 20s when I joined E.F. Hutton. And my boss at the time, who trained me how to think about markets, was chairman of the COMEX also. So I used to go down to the floor and watch it, all that stuff. But I've never seen markets so configured. I'm talking of our macro technicals now. And I know some of the fundamentals that are behind this, but that's not my subject matter. Are such dynamic and pending dynamic condition that 2025, all hell's going to break loose. I thought it might begin late last year, but it was delayed. But I don't think it's going to be avoided. And that is, we've already seen gold make a statement. Now, few people, except in other parts of the world, even acknowledge it, that there's gold's made a statement. I mean, gold was up more than the S&P and the NASDAQ last year. Was that announced on Fox Business or CNBC? No, stock market. And, even in the last 12 months, at the close of February last year to where we are now, almost at the close of February here, silver's up 48%, gold's up 44%. I know silver seems like it's lagging, but actually, from an investment point of view, it's up more. And the public still isn't excited. They'll get excited when a couple of events happen, and I think they'll be coincident. Dollar's going to break down. It's already in the process. It's about 2.5 points away from hell breaking loose by our metrics. Long-term momentum trends breaking. Okay. 2, the stock market is, I think, topping. And I think it's literally within about that many percentage points of breaking through stuff on momentum that says top in place, downside. And when you start to offset the stock market joy and cause people to move money, they look around and say, well, what's working? And there don't have to be a gold bug to finally realize, geez, I missed this. What's going on over there? And you've got the mining sector, which I think is the best place to be in 2025, silver in the mining sector. Gold's the mama, but they're gonna lead on a percentage basis. I think that's where you're going to get a huge boost in that sector, dramatic. And it's not so much due to this event or that, it's due to the money flow out of a breaking bubble.
Okay, so just to recap that, 2025. I want to pick apart the all hell breaking loose headline a little bit. That leads with a stock market breakdown. We crush some downside momentum. Capital flees the stock market, looks for a new, safer home. A lot of that ends up in gold, trickle down to gold equities. What's the US dollar implication in that scenario? Like, my intuition would say when capital flees anything, US dollar catches a bid. But what's your take on that?
Well, there's a lot of talk about, hooking the dollar up to gold. I cover my ears on this. What governments do come and go, okay? And there's an ultimate reality. The reality is gold is reality. Gold is money. It's stepping out of the credit markets that are vulnerable. Paper that is vulnerable. It's the real thing. And so when we measure gold against the dollar, we say, oh, it's going up. No, the dollar's going down. That's what's going on in terms of its real buying power. And the last 2 years, the dollar index has been in one of the narrowest ranges it's been in for many years. It's been in about a 10% range, less than that, really. And no volatility at all. There's volatility elsewhere, but not in the dollar index, which is really the inverse of the euro and the yen, by the way. That's 70% of the dollar index. That looks susceptible technically to us to break its silence and suddenly become a volatile major asset category. And when you upset foreign exchange trends, you upset other investments that are based on that. We got a lot of foreign investors in the U.S. stock market. Mm-hmm. They had to use dollars to buy U.S. stocks. So their vulnerability isn't just whether our stocks go up or down. It's whether the dollar goes down, because they lose on that end too. And so that could, if the dollar started to break, it's already, dropped 4 points off the high of a month ago, 4%. You drop another couple, and I think it's going to start to precipitously drop and wake up, meaning volatility comes in. That will impact other market arenas. And I think one of the arenas it'll hurt is the stock market, and I think it'll help gold. Although gold has proven it doesn't need a weak dollar. Dollar's risen since 2015 low in gold. Gold went up 2.5-fold, okay? Dollar index has gone up 9% or so.
Right.
So it hasn't been weak, and yet gold's exploded. So gold looks at bigger things. Okay, anyway, I think we got dynamics coming.
Yeah, well, and you hammered a point that we hammer often on the channel, which is, gold is rising in price, but it's still the same asset. It's the measuring stick that's changing, and that measuring stick's been changing really quickly recently. So maybe just a segue into that. Do you have an inflation expectation for the year, Michael? Do you watch that? What's your take?
I think we'll accelerate this year. In other words, rather than the arm wrestling process where every couple $100 they doubt gold. The internet just fills up with people saying, "Oh, that's the top. Oh, it's going to correct." We've had so many of these calls over this past year, for example, that every one of them was wrong. The gold call and therefore we're going to correct, and it didn't. Or it corrected only halfway, and then suddenly you're at a new high. So the guy who made money the last year was the guy who laughed at those reports and that analysis and bought into every time you made what looked like a top and you bought it 3 days later, did quite well. You know what I mean? So you buy the weakness, and I think we're going to enter acceleration, meaning instead of 3 steps up in gold and 1 back, it's going to be like 10 steps up and 2 back. And in the case of gold, instead of 4 up and 2 back, it's going to be like 10 up and 1 back. So I think what will cause that are these other external factors.
So Shane, I want to push it over to you, because when Michael talks about, 10 steps up and 1 back, or 4 steps up and 1 back, like, you hear about the back step, I imagine, being the company builder who's managing shareholders in addition to your own emotional journey and your team. And so, how do you manage that do you attach yourself to the gold price so much? Walk me through your management of the volatility of the gold price as you're building a gold company, putting one back into production.
So yeah, look, as a company, gold company in the space, you can't get too concerned with the price of gold, particularly as a developer. As you're moving forward, gold will come and go. But it's very important for the cyclical nature of gold when you're building a gold project. If you can start a gold project and move into that rising gold market, that gives you a lot of a good runway. as we move forward. So that's critical really in building a gold price. And a good gold price is part of the project. But from a shareholder's perspective, as you both know, the equities haven't really moved like the gold price. Our gold price is up at an all-time high, but the equities, gold mining equities in particular, have still not moved, particularly down the space, down the level to the developers and down into the juniors. So, the shareholders are like, what's happening? We're having an all-time high gold, but our share price is not moving. So at the moment, that's a very unusual place to be in the market. If you remember the last gold market, a number of years back, 10, 11, this gold went and all the share prices went very quickly. So that's, as a gold company, as a developer, you've got to be wary of that and just keep going and developing your project, moving forward, knowing that eventually catch up.
What's your take on that, Shane? Because you're right. Often the pillar idea moves and all the smaller sort of ancillary opportunities move after in any market cycle is what I mean. And in gold, typically the metal moves, then the major royalty and production companies start moving, then the mid tiers, then the juniors, et cetera, et cetera. We haven't seen the trickle down effect. Well, I would say that we have to a degree because a lot of the major miners are at like 52-week highs or close, but investors are never satisfied, right? So what's your take on that trickle down, the timing and managing that sentiment?
Yeah, as you said, we've seen the majors move. Some of the majors have moved, and we're seeing some fantastic quarterly results. Newmont just came up today. Agnico, all the big, they're generating massive cash flow. I believe it's only a matter of time before investors, as Michael said, they recognize that cash flow and they say, wow, these companies are generating all-time high cash flows. I would suspect that once that starts, they will start to move down. So I would suspect much towards the back end of this year, you will see the money move down through the levels to intermediates and then down to developers and into the juniors eventually. That's my take.
That could be good. That could be good timing for West Red Lake Gold. We'll get into that in a minute, back half of 2025. Last question on the macro front, and I'll pass it back to you, Michael. I just got to ask, what's your take on all the noise about auditing Fort Knox? So right now, allegedly, there's about $11 billion of gold in Fort Knox, but that's at a value of $42 per ounce. At today's valuation, if the gold is there, that's like $750 billion. But the question is, I guess the statement would be it has never been audited or hasn't been in many, many years. What's your take?
Let's see if it's there. I don't know. I don't think this is really an impactful thing for gold. I think it's something off to the side that was doomed to happen sooner or later, or destined to happen. And it'll just be interesting to see what the headlines show. My God, it's not there, or half of it's go. Where did it go? It'd be an interesting news story. But ultimately, what's going on in gold doesn't have to do with how much we got. There's bigger events. There's crises pending that have been developing not over just a cycle in the stock market, but over decades. We know it in government spending. We know it in the degradation of the money units, whether you're talking dollar, euro, or yen, not compare one to another. That's paper versus paper. I got them hanging on my wall. Who cares? It's that every 10 years or so, approximately, the money supply in the U.S. doubles. Okay, so when I was a kid, a loaf of bread was 20 cents. So what do we have, a wheat drought, and that's why it's high? No, it's the degradation in the money unit. The same is true with anything out there. Cow manure prices have gone up. Everything's going up because the degradation in the piece of paper we're carrying. And it's true with the Japanese, the Europeans, it's degrading money. It's not backed by anything. That's a crisis building. It's created debt problems. I think they're about to expose themselves, particularly in commercial credit markets, not so much in home real estate, but commercial credit. I think the financial sector is technically very vulnerable and fundamentally vulnerable. All these things are going to come into play in a bigger way than 2008 and 2009 did. And I think gold knows that's coming. I think some investors know that. That's why it's doing what it's doing even before the crisis that I'm talking about. And when that starts to unfold, that's when your average Joe on the street who's totally missed this will suddenly say, geez, what am I doing? I need to move some money into gold or silver. And they'll chase it. And that's when, for example, the miners will wake up in a dramatic way. And in fact, I sent you a chart that is very telling. in terms of that asset category and the likely compression that it's built over the decades. But anyway, the point is that this is XAU index. Now, what's the XAU index? Well, it's been around since the 1980s. It's the Philadelphia Gold and Silver Index. It's an index of miners, not the gold and silver itself. It's got a fair amount of silver miners in its top 20 holdings, by the way. So it's not just gold, okay, gold miners. But what this shows is the spread relationship or relative performance of the gold miners versus gold. And you could see from the mid-1980s through 2008, if you divided the price of XAU into an ounce of gold, it was trading in a range with lows at 17.5% and multiple highs up there near 30%. So it just lived in this very high range, oscillated up and down, but it was still at a very high level relative to an ounce of gold. And then in 2008, it started to break down. And by 2015, coincident with the low in the bear market in gold and the miners and silver, in December 2015, the spread of the relative performance of XAU stopped going down. Bang, it was coincident with the low in the net price. And since 2015, you can see that spread, which got down to about 4%, popped up into a range above that low and has lived in this, what you call a basement type range, because it's still very cheap, even when it goes up in that range. But it's not going back to that low, meaning that in point of fact, if you bought the XAU index around the December 15 or early 2016 lows in gold and silver, and in fact, we put out our major buy signal in February 2016 and haven't changed since. But if you bought the miners and you're actually doing better than gold, that spread is higher than it was then. Now, it's not dramatically better, and it's still in this very low basement type range. But when you look at this chart going back to the 80s, and you look at that action for the last 10 years now, in this little tiny range, it's still dirt cheap. And the range is definable. In fact, there's a 3-point downtrend line on this spread chart that goes back, decades. We've been bumping it all during last year, and now we're out above it. Now that's step one. There's also at the top of the range that is clearly definable. You ever get above the top of that range on that spread, and you treat this like a price chart. It is actually, it's price versus price. You could triple the price of the gold miners and silver miners in their relative level to the ounce of gold and merely bump the underneath side of that multi-decade range that prevailed from the 1980s through 2008. So even if you broke this out and only went halfway back up to those highs, bumped that prior floor, it couldn't get beyond it, that's still a tripling. In other words, over the next year or two, in this acceleration phase, which I think we're entering in gold and silver, the miners are likely to triple their performance versus gold, suddenly wake up in a way that is dramatic. And I think these other factors that we talked about that caused the spark of investor interest into this tiny little off-the-page sector will goose it up to those levels. Now, we measured MSA something closer up than that. That chart's monthly closes. We're watching day-to-day action, week-to-week action, and frankly, right now, when we shift over to GDX, the popular mining ETF, and it even has silver miners in it, it's very close to an upside breakout that would start this process. In which case, our bet is if you see gold continue on up here, it's going to start to accelerate. Silver's going to outpace it, and the miners are going to outpace it. And we're very close to the technical breakouts via the spread charts now. Forget the price, just via the spread of silver versus gold or the miners versus gold that says, okay, game on. And at that point, I think in 2025, I think we're on the cusp of that spread breakout. You want to be, watch gold, it's the mama. But the little dogs on the leash are going to suddenly run out in front of the mama. And I think that's about to happen. And I think that the geometry of that move could be quite dramatic in terms of relative performance. So, Shane's in the right place.
Well, I tend to agree with you. So let's get into that, because if I'm looking to capture some upside in this gold market, and I'm looking at physical and I'm saying, look, we're approaching $3,000. It's up there. The major miners are already at 52-week highs. Like, what's the next bus? And I would look for, mid-tier miners that have proven reserves in production or on their way, but have not caught the sentiment bid yet. I mean, that would be the key, right? It's like they haven't been caught up in this wave yet. Would you make a similar assessment?
Yep, I do. Did you want to ask Shane about that? But I think we're on the cusp of that. And I think the thing you got to watch is, watch the spread, as we do, of silver versus gold. Yeah. And I'll comment on that in a second. And the miners versus gold. When you see that spread start to break out, when you go back in the past and look at the tail end of the bull market in 1979 and 80, the same thing happened. The spreads broke out, and all of a sudden, silver exploded relative to gold on a percentage basis. There's been going up with gold for years, and then suddenly went vertical. And also that happened in 2010, a year before we peaked in 2011. All of a sudden, there was this acceleration phase in silver. And I think that's about to happen now in the miners and silver together. They're both in a position to really go vertical. In the case of silver, if you go back 50 years and look at the highest reading each year of what the ounce of silver was to gold, we do it as a percent. Silver was at least 2% in 20 of those 50 years. Right now, silver is 1.14% of the price of gold. Even if it just went to 2%, and asset gold didn't even go up, silver would be $60. Get the point? And $3,000 is not expensive for gold. The two prior bull markets in gold were eightfold. So far, this has been a double and a half. Eightfold for gold would be 8,000. So anyway, I think the dynamics are on the edge right now.
Yeah, and I love this market because you can actually look for companies that have gold but haven't caught that upside yet. As the gold market matures, if you're looking to capture upside, you need to keep looking further down the food chain and eventually into the exploration business, which is super risky. And you're kind of gambling on companies that might not even have the asset that they're correlated to, right? It's a much different dynamic where today you can actually look for companies that have proven gold reserves, just have not participated in that sentiment upside yet. And that's an amazing opportunity for investors. Shane, what are your comments on that?
Well, I certainly like Michael's view of the gold market, where it's going as a gold developer. That's good news. Yeah, so look, Michael has good views on the gold market, but from a project development space, I think, the trifecta effect is really the gold price rising. You're moving a project forward and you're hitting the cusp of that production as that gold price is rising. So that gives you, as a gold stock, as a gold developer, that gives you a lot of leverage. Not only are you moving from that developer into that producer, as you say, from reserves to production, which is always a sweet spot, but you're also moving into a rising gold market. So, that's sort of sweet spot we find. It's, Pierre Lassonde had a great curve called the Lassonde curve, and you're just at the cusp of that Lassonde curve from a developer perspective. And if gold is, going where we all think it is, then you get that lot of that leverage to gold. And it's important to find the right company. But if you find the right company, there's been a lot of leverage given over many years for companies, gold mining companies.
Agreed. And so let's talk about where you're at right now, and actually, as I mentioned before we hit record, this is super timely because all of my students in the Commodity University, we're in this material right now. The Nuance as a company graduates from preliminary economic assessment up to pre-feasibility study. If you guys go to West Red Lake Gold's website, check out the news flow, you'll find in early January 2025 that Shane released his PFS, his pre-feasibility study. And so what do we do next, right? You look for the economic indicators, you look for the annual production, and they're projected to produce around 67,000 ounces per year. Then you look for the all-in sustaining cost. You'll find that around $1,681 per ounce. Look for the free cash flow, around $70 million in free cash flow per year. It's all in there. So this is a great exercise. So walk me through, Shane, and moving towards production projected the back half of 2025. So Shane, I'll push it over to you.
Yeah, so I've been involved in project development for quite a long time, and there is a phased approach to these projects. As you said, your PEAs, and then you do your pre-feasibility study. We're in a unique situation, and most companies, as you know, Jay, they'll do a pre-feasibility or a early stage study, and then they have to go through a permitting process, and then they have to do construction process. It can take 10 years today to build a mine, as you probably pointed out to some of your students. We're in a kind of unique situation in that we have an asset was already in production, no permitting is required, ready to go. So we can move very rapidly from that phase, from the pre-feasibility study, straight to production, actually. And that's unique. There's not many projects like that around that get that opportunity to move from your studies into your operation and generate cash flow in such a short period of time. Most projects take many years to get into production. So that's very exciting. As Michael has said, gold prices in those sort of ranges as we're moving into production in the back half of next year. And leverage to gold is fantastic. It's a sweet spot. Call it the sweet spot.
And we covered this on previous episodes, so I won't go too deep into that. But the reason that Shane is able to expedite towards a PFS because his project's already permitted is because the Madsen mine, which we're talking about, was in production real recently, like in 2020, but due to some operational challenges, essentially the whole project broke down, and Shane and his team were able to therefore buy a distressed asset at massively discounted prices, bring in a new team. I think he kept a lot of the old team as well, and put this thing back into production properly and sustainably. And that's why you're able to move so much faster than most projects at this point in the company journey. Yes?
Yeah, that's really, as you know, Warren Buffett says the best time to buy a project is when there's blood in the street, effectively. So, you get cheap assets and you can use that at a right. If you get an asset undervalued, a gold asset undervalued, and you get the timing correctly as you were going into, both of those together create a unique opportunity. And that's what we saw, kind of a setup for gold. We saw this asset that we could turn around with the right team. And so those two came together at the right time. We kind of capitalized on it. So, as we move forward, there's a lot of margin now that we will develop over the next year and into 2026 and beyond.
So, and as we just said, the nice part about this market is that you can actually look for companies that have gold, not looking for gold.
Yeah.
Shane's doing both. So let's talk about the have gold, right? Projected to produce 67,000 ounces per year. That's from your reserve base back to the proven and probable reserves. My commodity university students dig into that PFS. You'll see around 1.3 million ounces, I believe, of proven and probable. Right. And then another bucket in the resource category. So again, reserve, think economics, resource, think geology, another 1.3 million in the indicated and measured resource category. Is this correct?
Yeah. So we have 600,000 ounces of reserve, and is what we're projecting in our pre-feasibility study.
Okay.
And then we have about 1.7 million ounces of resources. And so, the resource to reserve conversion, and then we're using that. You use that reserve to build a mine plan and build your economics and your projection going forward. And then, but you still have the upside of those resources, and they will convert over time. So your reserves are more for the next 5 to 7 years, and then resources are upside going forward. So you're correct. Production, reserves, and then upside long-term exploration on your resources.
Yeah. Okay. And then, so the three categories that I would sort of put you into, obviously you have your reserve, which is how you're going to move towards production. You have your resource, which you hope to upgrade over time, either through further exploration, infill drilling, learning more about the deposit, and then additional exploration upside occurring simultaneously. Correct, Shane?
Yeah, we do have that. Yeah. The unique thing about that deposit is, it was already developed, really. We're underground, we're developing, we're looking for new gold, which is the upside, as you said, the exploration. So we can kind of do everything together. A lot of mines are mainly in that early stage. Some of your students, probably early stage exploration. and then they move forward with studies and development. We're in that unique situation where we have that exploration ongoing and we have production, close to production ongoing. So that's not many companies have that at the right time. They're either in the early stage or they're in the production stage or in the development stage. We kind of have those three activities going on together.
Now, I actually just hosted a panel at my conference in Vancouver in January. The title was, "Is cash the most important resource in the resource business for companies like you?" And also earlier stage, we were focusing on this. Rick Rule and a handful of others joined me on stage to debate this. So first of all, what's your take? I'll ask you that question, Shane. What's your take? Is cash the most important resource in the resource business? And if not, maybe why not? And then maybe let's get into your cash position for context.
Yeah, look, particularly in our stage as a developer, cash is very important. And also in production. I believe, Jen, you see this, years in the last boom. Today, you'll see the majors are moving very, very quickly, who have cash production generating free cash flow. We're seeing that in the quarterly results. We're seeing that, and actually a number of developers have recently bought production assets, as you're probably aware, and they've got very good re-ratings. So the investors seem to be basically rewarding companies who are moving into cash and have free cash flow. Recently, we've had a number of developers who bought some of the Newmont assets, and that were on for sale, and they'd moved into cash, and they've got a lot of re-rating. So I believe in this market, cash flow will be rated much, much better than gold in the ground or reserves or early stage exploration. And we're seeing that so far in this stage of the market.
Okay. And I know you guys recently completed a raise and upsized along the way. So walk me through your cash position, Shane.
Yeah, our cash position at the moment is, we just did a raise. It just actually closed this week. We just closed it this week, actually. So we're in the middle of our finalizing, but at the moment our cash position is around $30 million at the moment.
Okay.
We also have in place a credit facility for another $50 million. So we have a lot of cash available to complete the project.
Yeah. So walk me through the timeline now, moving into production back half of 2025. What can prospective shareholders, existing shareholders expect to hear from you? I mean, it's February, beginning of the year, between now and first pour, or I guess I should say new pour, because this mine's obviously already poured gold.
Yeah, so we've committed to doing a bulk sample. One of the issues was around the resource and the geology and the understanding and the correct interpretation of that. So we're starting in March a bulk sample program where we take some of the mining, we compare it to the new resource model, and so that's going to be a critical catalyst for the market, in effect, to show that we've understood the geology, we've interpreted it correctly. So that should be at the end of March. We should be able to announce the results of that, and then leading on from that, we'll use that as a catalyst to move forward and start the ramp up of the project in the back half of next year.
Okay. Michael, I want to pass it back to you. If you're speaking to an investor who's maybe they falls into the category that we've discussed thus far, they've looked at physical, they've looked at the major miners, and they're like, but I want to capture the upside. Criteria. What are the criteria that they should maybe put on their hit list as they start vetting opportunities for cash deployment?
We don't deal with fundamentals. We know very little about specific mining companies, and frankly, we don't want to know too much because I don't want to be influenced by business operations and so forth. We do technical analysis, and I think Shane is in a good place. I even glanced at his stock the other day, and it's quite steady. And it's not really that volatile, and it looks like it's positioned to fully participate, in this groundswell that we're about to see. And so again, I approach things technically, and after the fact, we all have the explanation as to, oh golly, no wonder, it happened, and it's our conversation that you guys know what happens before the event. I'm telling you what the macro technicals look like, which will accelerate whatever you see that is positive and put it on a bigger stage. which I think is the key issue for that little tiny sector right now, is simply it is vastly undervalued by any metric of, profitability of the companies, the potentials, all that stuff is vastly underpriced, whereas other categories are vastly overpriced, as we know. And when all of a sudden they get punctured and the oops happens and people get skeptical when they look at TV and say, my God, my retirement's down 20%. That was the only good thing in my life was my retirement account. And, you drop. All of a sudden they say, well, what do I do? And there's all kinds of other variables out there that could cause the sense of doubt, not just the stock market. I think that the political horizon is, we thought it would be uncopacetic once the election occurred, no matter what's the outcome, because the other side would not like it. And certain things that we assumed might happen after he or she won are not likely to happen the way we think. And I'll give you one example, and it's in your area, Jay, commodities. Trump has said he wants to keep prices down. Well, his notion of inflation, and just like everybody else's, is consumer prices. That's BS. Inflation is the degradation in the money unit. It's a constant process. And from decade to decade, that degradation will sometimes positively impact, because the increase in the money supply will go into stocks. Well, we've seen 15 years of this now with free money, 10 of those 15 years. And even when they raised rates recently, they're still at trivially low levels, historically speaking. Look at a Fed funds chart going back 50 to 60 years. You'll see, who cares? That was hardly even a rise. Okay, so we had free money. We were drugged. Where did the money go? Into the stock market. Well, when those bubbles break, it goes elsewhere. And you go back in history, we did a report on it recently. My son did. You go back to the 1929 to 32 debacle. Gold wasn't tradable, but the hub stake mining went up like 1,000%. Okay, you go back to the other bear markets that we've had in recent decades. What went up? Gold went up during the 2000 to 2002 decline and continued up. From the 2000 to 2007, gold had one brief sell-off in October 2008, but basically was going up that whole time. It continued to 2011. It's always been the case that they go to gold. Also T-bonds. Now, this time around, I think any T-bond rally we get, and I think there's a technical potential for that, meaning drop in rates on the long end, is going to be temporary and deceitful. But when you get to the one asset category that is technically now primed to start another new leg up, is commodities. This time they're in sync with gold. Now, if you look at what happened prior to the war, is in October of 2020, they were a couple months off their bear low, which was in the 50s on the Bloomberg Commodity Index. Its high in 2008 had been 230 plus. And Bloomberg was trading in the high 50s. And then when it rose to 140, we call that a commodity explosion. In fact, we called it before it happened. It peaked 13 trading days after that war began. So the whole move had occurred well before the war, based on cheapness of that category and the beginning of some money flows into it. It was dirt cheap, historically speaking, compared to its own prices, dirt cheap relative to the stock market. It was low risk, high reward. The second leg is about to begin. In fact, we signaled it in January at 101 on the Bloomberg. We're now trading up toward 108. We think commodities are about to join gold. They weren't between 2015 and 20 when gold doubled off of its bear low, 1,050, went up to 2,070. Bloomberg Commodity Index kept going down. But now it's back in sync. And I think this year we'll also see that asset category and stocks related thereto, like agricultural related stocks, energy related stocks, base metal related stocks, and certainly the gold and silver miners because of the gold move. That's the better place to be. And it's simply an asset flow into a cheap sector. Again, Bloomberg's 108. In 2008, it was 230. So it's still cheap, relatively speaking. So that's going to be another category that is going to do what? It's going to surprise a lot of Trump investors who bought recently thinking, is going to make sure inflation doesn't go up again. Well, if you narrowly define it as commodities, you're about to be surprised. And it won't be his fault. It's just a normal, massive inhale-exhale process where asset categories do shift. Remember the late 70s. It was a dead wasteland for the stock market. Between mid-70s and 1982, the stock market did this. There's a whole half of an investment lifetime, waste of time, up and down, didn't go anywhere. Commodities exploded, and yet we're in a global recession then.
Right.
They
right.
joined gold in the late 70s, 77, 78, 79. They didn't match gold, but they went up with it. I think we're on the cusp of that again, and that will what? That'll upset expectations. And people will say, golly, nothing's working out the way I thought. What's working? And all of a sudden, they'll realize that the place to be is what we've been talking about. But these are all kinds of factors out there that are above and beyond the issues of specific miners and so forth. It's an issue of macro flow funds. And when the central bank gets panicked, Trump has already, back in COVID period, he told the Fed, cut to zero, should be lower than the rates in Europe, print. And I wouldn't be surprised he tells them to do that, or he does it himself. Perhaps by pricing gold up to 3,000 and using that as collateral to issue. You get the point. Things are changing, and expectations, all kinds of expectations, are going to get flipped over.
No doubt. Well, I think the headline is 2025 is the year all hell will break loose. We heard a lot about it. Look, I appreciate both of you coming on today. Thanks for your time, Michael, Shane. Great catching up with both of you. Check out West Red Lake Gold. Dig into that recent news release, the commodityuniversity.com for anybody who's curious. But what a great case study. Shane, I actually should have you come talk to the students and just walk us through the company journey. That'll be so let me know, guys. DM me if you want Shane to come on and come chat with us. Because I think there's amazing learning to be had right now from West Red Lake Gold. Shane, over to you.
Well, also in general, I've done a lot of projects, a lot of development. It would be good to walk through the stage of the process because, investors need to understand that and understand companies and how they move forward and the different stages of development of when is the best time to get involved, et cetera, and what they can see from the news releases. So I'd love to do that. So that's
let's offline about that. I'd love to make that happen. Okay. Hey, look, thank you both very much. I appreciate your time today, and we'll catch up again soon.
Thanks, Jake.
Thanks, Jake.
All right.